if you want to keep inflation under control, you need to keep the government debt levels under control.
Welcome back to Breakout from Breakingviews, brought to you by PGIM. I'm Peter Thal Larsen, the global editor of Breakingviews, coming to you from London, and delighted to be joined once again by Edward Chancellor. Eddie, good to have you back.
Yeah, nice to see you again, Peter.
So Eddie, you've written for us this week about economic theories. Every era in the global economy tends to produce a theory which meets the needs of the age, as you say. So you've been having to think about what theory might suit this era that we're in, of sort of inflation and higher interest rates. So where do you end up?
Well, think of it, the last 15 years, we had the financial crisis, and our old friend Hyman Minsky of financial instability hypothesis fame came to the fore. Then, in this period of extremely low interest rates, this almost laughable theory of economics called modern monetary theory was extremely popular, and it with the notion that governments didn't need to raise taxes, they could just issue money and spend, which is actually what they did. And now we are left with a combination of large government debt and inflation. And so the question is, we need a new economic theory to match these new, more dour and straitened times. And I think I've come across one.
So tell us about him.
So there's this extremely intelligent, articulate economist called John Cochrane at the Hoover Institution at Stanford. And Cochrane has pulled together various strands of thinking about inflation, which focus on the fact that inflations originate not with a printing of money, as Milton Friedman would say, but actually with excessive government debts. And Cochrane calls this the fiscal theory of he calls it fiscal theory, or he's written a book also called The Fiscal Theory of the Price Level, which has recently been published.
And he also writes a blog called The Grumpy Economist, which I guess gives you some indication of his general demeanor. But what?
Yes, I mean, Peter, you could say that what Cochrane is articulating is the exact opposite of modern monetary theory. He's saying that if you want to keep inflation under control, you need to keep the government debt levels under control. And there's definitely a germ of sense in this idea. And if you look back, as I mentioned in the piece, to the first inflation which appeared in Sicily in the 4th century BC, the tyrant Dionysius of Syracuse debased his currency in order to pay off his debts. And then we see, right through the Middle Ages, constant debasing of currencies when government get into trouble, followed by bouts of inflation. And then in the more modern period, we get central banks we get governments printing money and central banks printing money when the governments run out of money. And the best example of that, obviously, is after the First World War, several European countries, notably Germany, with massive war debts and an impaired capacity to collect taxes, suffered these extreme hyperinflations.
So if you then roll the clock forward a bit and apply it to the current situation, and I guess particularly the period after the financial crisis, when central banks did lots of monetary stimulus and there was no inflation, and then now obviously we had the COVID pandemic, government spending, and we've had lots of inflation. How does it does it explain that period?
Yeah, I think so. Cochrane has a rather smart answer to why quantitative easing, central banks going out and buying government bonds and mortgage bonds after the financial crisis didn't lead to inflation. Cochrane says money and government debt, money is just a form of government debt, and therefore quantitative easing was just a debt swap, swapping outstanding and long-dated bonds for reserves at the central bank, and therefore it was not a fiscal event and didn't lead to inflation. He has another interesting insight, which is in his model, he says that when interest rates decline, inflation falls. And that's a very novel insight, but not crazy, because the way he looks at it, when interest rates decline, the cost of the government debt becomes more sustainable, and therefore there's less likely to be inflation. Now, conversely, when interest rates rise, as they've been doing recently, actually the government then has to raise more money with tax revenues to pay for the greater cost of servicing the debt. Therefore, in a rather simplistic model, it would argue that higher interest rates are inflationary. And again, there's something in that. You see, as you know, recently, because the governments, the central banks, in effect, owe the banking system a lot of money. As short-term rates have risen, the cost of servicing government debts in Britain and the US has been rising very rapidly.
So you quote in the piece of the statistician George Box, who said that all models are wrong, but some are useful. I mean, is that kind of how you would think about this theory? Because I mean, there are some flaws in this, or some big assumptions, I suppose, in Cochrane's ideas, which aren't really reflected in reality.
Yeah, I mean, that's true of really all academic economics. They live on a different planet to you and I. That some of the assumptions, that, for instance, the notion that people operate with what economists call rational expectations. They have all the information available. They see perfectly into the future, and they're rational. Well, I mean, if you worked in the investment world, that's not true. The investors, at best, their knowledge is what economists call bounded or limited, and their time horizons are myopic. I don't think it's a model that actually fits how people behave, but it has a germ of insight and truth. And there are some, I think the reason why it's well fitted to the current day, we have inflation and massive government debts, and governments are going to have to coordinate with central banks in order to bring down inflation. And this coordination of monetary and fiscal policy has really, as you know, been lacking in the last 15 years. So people have got to wake up, the policymakers got to wake up on that front.
I mean, which effectively is equivalent to inflating away the debt, which, if you're a holder of government bonds, is probably not a terribly attractive prospect.
Yeah, well, I've written in the past about financial repression, the policy of keeping interest rates below inflation in order to inflate away the debt. So there isn't any real theory for financial repression. It's just an opportunistic act. Now here, Cochrane, he's not saying so, but he's really providing a theory to support financial repression, which is, frankly, what we're going to get for the next, umpteen years. So I think as I finish off the piece, I was saying, well, the bondholders have done well since the regional banking crisis a month ago, but I'm pretty confident that those gains are short-lived and that we're in for a time of financial repression. And it appears to me that fiscal theory supports that policy.
Eddie, fascinating as always. Thank you very much. Talk to you again soon.
Great, thanks.